Okay, good morning. Welcome back. It feels like so long since we've been in here. Today what we're going to do is we are going to start Chapter 9, which is liabilities. So what we've done up to this point in the course is we have gone through the balance sheet through all the assets. Now we're into liabilities. I will tell you that the final is not cumulative, and it tends to be a little bit higher scoring than Exam 2. So you've made it through the worst. Okay, so we have this question up right now, learning catalytics. Which of the accounts below is usually not a liability? So we're looking for what is not a liability. So as we go through the list, if you see the words payable, that tells you right away that's a liability. So interest payable, taxes payable are a liability. Unearned revenue is a liability account. Unearned revenue is where you've collected money from the customer but have not performed the service yet or sold the goods. So investment in bonds is an asset. We talked about that in Chapter 8. So investment in bonds is an asset, okay, which is different from bonds payable. Okay, so the answer is investment in bonds. That'll stay open for a few minutes still, so you want to make sure you get your answer in there. Got some administrative announcements to start with. Okay, Exam 2. If you want to see Exam 2, go over your exam. You can this week. I'll be emailing out this announcement this afternoon. The times to see Amir are Wednesday from 12 to 3, Thursday from 10 a.m. to 1 p.m. Okay? So Wednesday, 12 to 3, Thursday, 10 a.m. to 1 p.m. I'll come back to that. I'm going to email it to okay. The exam average was roughly 71%. If you want to see a list of all the exam scores, you can download an Excel file that lists all the exam scores from highest down to lowest. There were a few people that got perfect scores. You can download that Excel sheet at http://tiny.cc/exam2scores. Okay, so if you just want to see how you did in relation to others, you can download that list. It is there. When you download it, sometimes depending on your setup, you need to save it, then go into Excel and open it. So sometimes you can't just open it from downloading it. So just know that sometimes you have to do that. Okay, so the exam scores list is tiny.cc/exam2scores. It's the average of all the scores on the sheet. So on the sheet it says it. Okay, and again, you can see your exam scores with Amir this week, Wednesday 12 to 3, Thursday 10 a.m. to 1 p.m. He'll be in room A230. Okay, and when you go in there, that's the computer lab that's past the ones you take the exams in, and he'll be back somewhere in the corner. Again, one last time, his hours, and I will email this out again this afternoon so you have that as well. Okay, due this week is the Chapter 9 homework. It is what we're covering in class this week. I will be emailing out the step-by-step videos today or tomorrow for the chapter homework. So you'll have that. And then we're into Chapter 9 liabilities. So liabilities. Liabilities are debts we owe. It's obligations we have to pay others. And there's current liabilities and there's long-term liabilities. Now, when we split out current liabilities, okay, we do have a handout today. I guess I should mention that. I saw most of you coming in the door, picking it up. It was at the door. I did that just to save your typing. Amir is offering it online, and when you log in online, it pops up. So this is just to save writing, because there's a lot of writing. This same handout will be today and Wednesday. So to save it. But on that handout, first we start with current liabilities. There's two, when we talk about a current liability in general, it's anything that's due within a year, generally a year. Okay? If you're an accounting major, there'll be a more precise definition down the road, but this is a good general definition to get us started. So current liabilities are debts that are due within a year, and there's two types. There's known amounts and estimated amounts. Okay? So we're going to start with the known amounts. And the known amounts is, now we're on the handout, the known current liabilities of a known amount is the top of page 1 on the handout. Okay, so we have this variety of current liabilities. And again, current liabilities are things that are due within a year. And this is on the handout. It's the first, top of the first page. We have, first of all, we start with accounts payable. Accounts payable, we're not going to cover in depth because we've seen it over and over. Accounts payable is when we're business and we go into, example, Staples, and we buy a bunch of copy paper, and we say, we'll pay you in 30 days. So we buy supplies on account. So accounts payable is what we owe generally other businesses. And it's due within a year. So that's accounts payable. But then we move down to the next item, which is short-term notes payable. Short-term notes payable are formal loans. Okay, we sign a formal note. The difference generally between short-term note payable and accounts payable, the big difference is notes payable we pay interest on. Okay, accounts payable, generally we do not need to pay interest on it. So some things to know about short-term notes payable. They're due within a year. We can use them to borrow cash or to buy an asset. Sometimes if you go in to buy a big piece of equipment, they will have you sign a note, and you will pay the note back at a specified day within a year, and you'll pay interest on it. And you have to accrue interest expense and interest payable added on it, which we'll talk about coming up. Okay, so short-term notes payable, they're current liabilities. We borrowed money, we signed a note, and we owe some party, a bank or investors that have bought our notes, and we're going to pay interest on them, and we're going to have to pay back the principal. So we have an example we're going to go through, and this is real life. Detroit Public Schools is struggling financially. So in an effort to not have the state take them over, they said, we're going to issue notes. So in September 2015, Detroit Public Schools issued $121 million of notes. Okay, and this is true. I've rounded some numbers just to make it easier for us. So they sold $121 million. Their fiscal year end is June 30th. Okay, so that's like a lot. Kent State's fiscal year end is June 30th. But they would still prepare financial statements at least every 6 months, probably every 3 months. The assumptions I'm making here is we're just going to assume they sold the note September 1st, 2015. The maturity date, August 31st, 2016. And the coupon rate is 6%. Coupon rate is what these notes sell. By the way, if a corporation, let's say Apple, were to go out and issue notes, Apple would probably pay very low interest rate, like 0.5%. I don't even know what Apple would pay, but they would pay a very low interest rate. Detroit Public Schools is struggling financially. So for them to loan money in the marketplace, they have to pay a higher rate because they're higher risk. So investors are demanding a higher return. So this is one case where interest is pushed up. So a coupon rate means these notes that they're issuing they're borrowing the money for 1 year. So they're going out, they went out September 1st, they collected $121 million, and now they owe $121 million, and they're going to pay 6% interest on those notes. So what we're going to do here, and this is in the handout. I must apologize. When I was putting this together, I skipped ahead, so you'll see 2016. You just have to, my calendar is 2016. I meant 2015. So the issue date was September 1st, 2015. Okay, so they sold these notes September 1st, 2015. So when they sell it, what's happening is they're collecting cash, and they are issuing a note. So we have a liability there, short-term liability. So we're increasing an asset and increasing liability at the same time. So when we issue the note, we're simply saying we're getting cash of $121 million, and now we have a liability for $121 million. So this is what Detroit Public Schools did on the date they issued the note. Okay, so that's on your handout. So now we're going to work down to the next journal entry. Now, the next journal entry is an accrued liability. Accrued liabilities are when we owe the money, but we have not yet paid it. Okay? So we're going to go through an example with the same thing. So September 1st, 2015, they issued these notes. Okay. So let's assume they're going to do financial statements on December 31st. Okay, so that's a quarter ending. So that's Detroit Public Schools quarter ending or half year ending. We could even assume that would be their year ending. It's not, but we could assume that. So December 31st comes along. So they issued these notes. They have a liability for $121 million. So since September, we have 1 month has gone by, 2 months has gone by, 3, 4. So 4 months have gone by. So Detroit Public Schools has borrowed $121 million for 4 months as of December 31st. So what they're going to do at quarter end is take the $121 million times the 6% times 4 months divided by 12. Okay? So we're going to have $121 million times the coupon rate of 6% and the 4. Where did I get the 4? I got the 4 from 4 months, September, October, November, December 2015. They're preparing statements. This is an accrued liability because they owe the interest. They've used the money for 4 months, so we need to recognize that interest. So the interest that we need to recognize at this point is $2,420,000. And that's the principal amount, the $121 million, times the coupon rate of 6% times 4 months out of 12 because 4 months have gone by. Okay, so what we're going to do is we're going to do an accrual entry, and the accrual entry is we're going to debit interest expense, okay, and that's an expense. We're increasing the expense because we've used the money. So we owe the interest for the 4 months. We've incurred interest expense, and then the credit is going to be to interest payable, which is an accrued liability, and we're increasing that as well. Okay, so this is as of December 31st. So we had to recognize that we borrowed the money for 4 months. We owe the interest on it for the 4 months because we want our financial statements to reflect that interest. So now let's just fast forward and let's skip all other reporting dates and let's say, okay, we're back to our calendar. So we had the quarter end. Now we're going to skip any other financial reporting because we could keep accruing, but we'll just pretend we had the one accrual. Now we've got the maturity date of August 31st, 2016. So since the last time we accrued, we have had 8 months go by. Okay, so we had the 8 months go by that we've used the money. We have 8 months more that was gone by. We need to recognize interest expense for those 8 months because we already recognized interest expense last period for the 4 months. Now we have 8 months. So if we take the $121 million times the 6% times 8 months out of 12, we will get $4,840,000 interest expense. And that calculation is actually not written on here. Okay, so that 8 months interest is $4,840,000. I got that by taking the 8 months since the last time we calculated interest times 8 months over 12 times 6% times 121 million. Okay, so that the $4,840,000. Make note of that because we're going to use it in a minute. Okay, so we had the interest accrual that we did in the beginning for as of December 31st for $2,420,000, and then we have this next 8 months of interest. If we wanted the full year of interest, we could do the 6% times 121 million for the whole 12 months, but we've got 4 months that we would have accrued already. Now we have another 8. So what we're going to do next is now we're going to do the accrual entry. And when we do the accrual entry, we've got a couple entries. First of all, we need to get rid of the original liability. When we issued these notes, when Detroit Public Schools issued these notes, they put a liability on their books for $121 million. Now, we're going to wipe out that liability. We don't owe it anymore. Detroit Public Schools doesn't owe it anymore, so we're going to debit it to get rid of it. So that first in the entry on the bottom of the first page of the handout, note payable short term, the $121 million, we are wiping out the liability. Okay? Next down, interest payable. Interest payable is from the accrual entry we made on December 31st. So we need to wipe out that payable as well. At the end of December, we said we owed interest of $2,420,000. That's what we owed as of December 31st. This is now August 31st. We're paying it off. We don't owe it. So we want to debit it to get rid of it. So it's just picking up, reversing the accrual from mid-note. And then interest expense is the interest since December 31st. So that was the 8 months that we did, January through August. For interest that we need to recognize interest for those 8 months because we haven't recognized those 8 months yet. So now what we can do is we can add our debits up and we will get our credit of cash of what we actually have to pay. What we actually have to pay is the $121 million plus 6% interest for a full year. So that's what the $128,260,000 is. Okay. Okay. So that's an example of an accrued liability. We accrued it at December 31st. We accrued the interest because we owed the interest. We had not paid it yet, but we had used the money. Okay. Okay. So now proceeding. Okay. We also have payroll liabilities. Payroll liabilities are things like wages payable, could be federal withholding, it could be FICA payables, but we're going to go down to unearned revenues. Now, unearned revenues we've been talking about it this semester. Unearned revenues are when we collect the money ahead of time and we have not yet performed the service because that's not revenue. For an example, this just happened to me last week. Last week I was supposed to go see, I'm going to date myself here, but we all know I'm old anyway. I was supposed to go see Meat Loaf last week. They were going to be at the Roxino in Northfield. So I had bought tickets, and the day before the concert I got an email that Meat Loaf was sick, so they were not coming. So at that point, the Ticketmaster had to refund my money. So Meat Loaf doesn't get to keep that money. That would be unearned revenue until they actually perform the show. So there was a liability there. Ticketmaster has a liability, or Meat Loaf, however they work it between them. But that concert, when you buy concert tickets, that is unearned revenue for the venue until they actually perform the service. Because if the concert doesn't happen, like this one, the Meat Loaf concert did not happen, they are on the hook to refund the money or offer an alternate date. Okay, so rolling with this idea of concerts, we're going to have an example. Unearned revenue is a liability until it's earned. So unearned revenue is actually a current liability. It will always be a current liability. You need to know that unearned revenue is a liability until you earn it. And we're going to see how you can earn it here. Okay. So unearned revenue is a liability until you earn it. So we're going to go through a concert example about how we would earn unearned revenue. Okay, so continuing with the concert theme, Adele, when she sells a concert ticket, she has unearned revenue until she performs that concert. So you buy an Adele ticket from Adele or from the venue directly, that's unearned revenue. So let's go through a little example. So on December 17, 2015, tickets for her concert dates in North America sold out in minutes. So there were 56 concerts in 2016 she's going to be performing. So they had 56 concerts, they put the tickets on sale, and they sold out. There were 750,000 tickets available. 10 million people were trying to buy tickets. So they sold the 750,000 tickets within the course of a few minutes. And let's assume, this is a low number, but let's just assume 750,000 tickets were available. Let's assume an average ticket price of $75, just to keep the number semi-small. So when Adele, and let's just assume Adele's getting all the money. There's some cuts for the venue and that kind of thing, but let's just say Adele gets this money. So on December 17th then, so December 17th, 750,000 tickets go on sale, average selling price $75. Cash coming in to Adele is $56,250,000. So she's getting over $56 million. So she has an asset for cash. Obviously the bank account's fat. But on the other hand, that credit there is to unearned revenue. That is a liability. It is a current liability because her obligation is within the next year. She has to perform all these concerts. So that's the first thing. That's when she initially recognizes this liability. She's gotten cash. Now let's say, okay, so we have a $56,250,000 liability on Adele's balance sheet. Next up, okay, so if we had that liability as a T account, we're going to take that $56 million, put it, it's a liability. Liabilities have a normal credit balance, they increase with credits. We credited it here, so we'll put it in our T account, have a $56,250,000 liability balance as of the end of the year. Because none of these concerts were until 2016. So she would have come the end of December, had this $56,250,000 liability on her balance sheet. She also has the cash, which is great, but she's got the liability. Okay, so now let's say the very first concert she's going to on that tour, the first concert is in St. Paul, Minnesota at the Xcel Energy Center, and it's July 5th, 2016. So let's imagine it's July 5th, 2016, and Adele performs that concert. Now that venue has 18,000 seats, so going to 18,000 seats times a $75 average ticket price. On that day, she is earning $1,350,000 for that venue. So she is going to, what she's doing here is she no longer has a liability for that $1,350,000, right? Because she had 18,000 concert goers, $75 a ticket. Now that she's done her concert, she doesn't have that liability anymore. So we're going to wipe out the liability, we're going to debit unearned revenue, and we're going to credit earned revenue, concert revenue for that venue. So as of July 5th, at the end of business, July 5th, the concert's over, she will have earned $1,350,000 of it. So now she can reduce her liability. She's going to debit that liability, and if she were to do a balance sheet right after that concert, she would find that her liability for concerts for that year is now down to $54,900,000. Okay, so as she performs the concerts, she's going to be able to recognize revenue for each concert. So unearned revenue is a liability, and it's a current liability because it's due within a year. So it's goods or services that we still have to perform, but we've collected the cash ahead of time. Okay, next type of liability is this last one, and I mention it because it does look odd. There's actually a line called current portion of long-term debt. The current portion of long-term debt is the amount of principal payable within a year. I want to emphasize that. You should write this down because we're going to have a question coming up about it. Current portion of long-term debt, amount of principal. And I've made the word principal big because that's the key word. This is how much principal we have to pay back over the next year. It's not the interest. The interest is an interest payable, but the actual principal we have to pay back is considered current portion of long-term debt, which is a current liability. Okay, so current portion of long-term debt is the amount of principal payable within 1 year. Okay, emphasis on the word principal, not interest. Interest goes into interest payable. We'll see that in a different spot. Okay, so before we go on, quick question here. Purchasing merchandise inventory on account results in a liability. True or false? Okay, purchasing merchandise inventory on account. So let me just kind of walk through what's going on here. When we purchase merchandise inventory, so there's inventory. Inventory is an asset, right? So we're going to have inventory. Inventory is going to increase, right, because we're getting inventory. On the other hand, the next words given, that's an inventory is an asset, and the next words given are on account. When you see the words on account, it means either accounts receivable or accounts payable. It's one of those two. Accounts receivable is things that our customer owes us. This is not the case. Accounts payable are our suppliers. So in this case, on account would mean we'd have to be using accounts payable. Okay? So we purchased inventory. So now we have inventory, but now we also have accounts payable, which is an increase. We're increasing a liability, right? Because accounts payable is a liability. So if we purchase inventory on account, we absolutely positively do have a liability. So I'm going to close this question in about 5 seconds. So make sure you have your answer in there. Okay, so that is true. Okay, so now moving on. So we said that we've gone through all these assets of current liabilities of a known amount. Now we get into the estimated amount. So we started the class with there's two kinds of current liabilities, known amount, which we went through, like accounts payable, notes payable, interest payable, unearned revenue. Those all have something very much in common that we can identify the amount. We either know from a contract, we know from a sales invoice, or we can do a calculation. We can take the interest rate times the principal. So we know all of that. So now we have this other category called estimated amount. these are current liabilities that are something that we'll have to pay, most likely have to pay within a year, but now we're going to have to estimate the amount. Okay, now these are called contingent liabilities. The formal definition of a contingent liability is a potential liability that depends on a future outcome of past events. We're going to go through an example. The biggest example of this kind of thing is somebody filed a lawsuit against you. So the future outcome would be what's the ruling on the case, and the past event is what happened in the past to give rise to the lawsuit. Okay, and you have this slide in your handout, okay? So you have this slide at the bottom of page 2. So when we say we're going to accrue, the loss is probable or the amount is estimatable, or we disclose it, the loss is reasonably possible. Now, down the bottom I have do not accrue or disclose if reasonably possible. This is frivolous lawsuits. We do not report every single potential contingent liability because some things are just not going to happen, or the likelihood of them happening is so slim. So if someone sues us in a completely frivolous lawsuit that there's no hope of them winning, that will not be disclosed. We have all kinds of potential contingent liabilities. We only disclose them if either we accrue it, meaning we put it on our financial statement, if the loss is probable and the amount we can estimate. We don't put it on the balance sheet or income statement, but we disclose it in the financial statements if the loss is reasonably possible. And I'm going to illustrate this with an example. So Volkswagen has been in the news a lot lately, not in a good way. Volkswagen has a lot of contingent liabilities for this emission cheating scandal. So what Volkswagen did is for several years they sold their automobiles, and I'll just talk about in the U.S., but this is the worldwide phenomena. They sold their vehicles in the U.S. Touting their environmental friendliness, that they had lower emissions than other vehicles, and these lower emissions qualified buyers to get the energy credit from the IRS. And but what was actually happening in the background is the engineers for Volkswagen had developed software, because all the engines have software in them now. And this software was actually pretty sophisticated. And what it would do is it would detect, it would run all the time in the background, and it would detect when that vehicle was in a testing situation. And when you're in a testing, so it would test continuously for the car not moving, because in a test situation the car doesn't move, they just rev up the engine, and so it would test for all these conditions, and then the engine would be able to tell, the software could tell if the engine was being tested or not. So if the software found it was in a test environment, all of a sudden it would ratchet back all the performance of all the systems. Because if you're in a test environment, you don't need to propel the car. So it would just continue to make the noise and look good, but it would ratchet back the power. So then the emissions looked a lot lower. It passed all these tests. Wonderful. But in reality, the emissions from a Volkswagen engine, the engine would not be able to perform if it was at the level that the test conditions were. But when in reality, when they remove the software, the emissions are actually 40 to 60% higher than allowed by law. So this is actually the exact opposite. So now Volkswagen has a mess on its hands, a public relations mess among other things. But Volkswagen has lots of contingent liabilities. Let's talk about gift cards. Volkswagen, and I'm looking at this from the U.S. standpoint, Volkswagen has come out and said, okay, everyone that bought a Volkswagen from us in this period of time is going to get a $500 gift card. Okay, so everybody gets a $500 gift card. We're going to fix all the cars as best we can. They're actually very close to having a fix for at least bringing the emissions down. They're going to fix all those cars, and then the regulators are after them. Okay? Now, there's lots of regulators. The EPA is the big one. The IRS is going after Volkswagen. Why? Well, because when customers bought Volkswagens and they were emission friendly, then those individuals could claim a credit on their tax return because the IRS, Congress instituted this program where you would get a credit if you bought certain energy efficient vehicles. So the idea was to incentivize the U.S. population into buying these energy efficient vehicles. So Volkswagen customers took this credit, where in reality, these cars are not energy efficient at all. So the IRS isn't going to go back to the individuals who took the credit because that would not be fair to them. So in return, instead, the IRS is going after Volkswagen for those credits and penalties and all kinds of things. So when we look at these contingent liabilities and run it through those tests, the first one, gift cards to U.S. customers. So accrue. If we're saying we're going to accrue a contingent liability, Volkswagen is going to have to say, here's the amount of it, and I'm going to put it on my income statement and show a liability. Okay? So it's going to reduce income, it's going to increase liabilities, not a good thing. But gift cards to U.S. customers, the first thing we ask ourselves, is the loss probable? Oh yeah, because Volkswagen has come out and said, we are giving everyone a $500 gift card. So the loss is probable, and can they estimate it? Sure, they know how many cars they sold. They can take the number of cars they sold times the $500. So that first one, we would accrue. There's absolutely a contingent liability there. Okay, mechanical fixes to cars. Is the loss reasonably possible? Yes, Volkswagen has to fix these cars. And can they estimate the amount? Most likely, yeah, they probably can because they have a pretty good idea of what it's going to take to fix each car. So this one they're going to accrue. So when you accrue, it's showing up on the balance sheet as a liability. It's showing up on the income statement as an expense. And you're talking about it too in the notes. Okay, now the third one, penalties from regulators. The first category under accrue, it says, is this loss probable? Yes, regulators are absolutely going to penalize Volkswagen. Now the next item down is the amount estimatable? So does Volkswagen know how much? No, they can't estimate the amount. There is no playbook that says if you cheat on emissions testing, this is your fine. They have no idea. They know the fines are going to probably be historic. They're going to be huge. So Volkswagen cannot accrue for the penalties, but absolutely they need to disclose. And by disclose means in the notes to their financial statements, they're writing a lot in their notes about this contingent liability. They want investors to know about it. They are giving them information about how many agencies are going after them. They've got the IRS, they've got EPA, they've got a lot of states suing them. There's lots of class action suits going against Volkswagen. So Volkswagen has a lot of contingent liabilities. Now, if Volkswagen had a lawsuit, I'm just making this up, let's say Volkswagen had a lawsuit from someone who was suing them because they didn't offer a car in pink, okay? Would they accrue or disclose that? No. No, because the chance of that person winning that lawsuit is not reasonably possible. It's very slim. So we don't recognize all contingent liabilities. We only recognize the contingent liabilities that are probable and estimatable, then we accrue, or reasonably possible, then we talk about them. But the frivolous stuff, we don't recognize. We do not recognize on our financial statements. So not all contingent liabilities, but these certainly are. So that's an idea of contingent liabilities. These are ones we have to estimate. We don't know them for sure. We can reasonably estimate them as the case may be. Okay, so got a few questions here. Let's see. Yeah, so we're coming to the end of the current liabilities. We're going to ready to segue into long-term. So before we do that, we're going to do a few questions. So this first question here is the current portion of long-term debt refers to the amount of interest on a note payable that must be paid within the year. I want to point something out. The big key word here to evaluate is interest. And we just had this. Okay. Current portion of long-term debt, is that referring to the amount of interest on a note payable? Okay. Okay, so on this one, when we talk about the current portion of long-term debt, if we're talking about interest on long-term debt, that has its own account called interest payable. We accrue for that. So that's in a separate account. When we talk about the current portion of long-term debt, we are absolutely talking about the principal. So earlier said current portion of long-term debt is based on the principal. So that's why this one fails. That's why this one's going to be false. I'm going to close this question in about 5 seconds. Okay. So yeah, because the interest payable is its own account. Current portion of long-term debt is principal. Okay, another one. Got a few here. Okay, this one we were just talking about. All contingent liabilities, even the frivolous lawsuits, should be reported on the financial statements, even those that are unlikely to occur. True or false? Okay, now, when you're answering this, at the bottom of page 2 on the handout, there's a contingent liabilities box, right? And at the bottom there, it says, do not accrue or disclose. Do not accrue or disclose is the same as reporting on the financial statements. Okay, that's what it means. If we report something on the financial statements, we accrue. If we report contingent liability, we're either accruing or disclosing. So reported on the financial statements is accrued or disclosed, okay? And then if not reasonably possible. If not reasonably possible is unlikely to occur. So when we look at this, all contingent liabilities, so the word all is key there. All contingent liabilities should be reported, even if they're not likely to happen. So the person that is suing Volkswagen for not offering the car in pink, should we report that? That would make no sense, right? So at the bottom of page 2 on the handout where it says do not accrue or disclose if not reasonably possible, means that there are some contingent liabilities we do not report. If there's a remote chance, if it's so slim, if it's not reasonably possible, we don't report it. Companies have hundreds of frivolous lawsuits filed against them. They can have a lot, and they don't disclose those because the chances of happening are not good. Okay, so I'm going to close this in about 5 seconds. Again, we are only reporting contingent liabilities on the financial statements that are reasonably possible. Okay? Otherwise, we do not report the contingent liability. Okay. So that is false. I think I have 1 or 2 more, and then we'll go on. Okay. All of the following are reported as current liabilities except. Okay. All the following are current liabilities except. Okay, and to answer this question, all you have to do is go to the first page of the handout, the very top slide, and identify which item is not on there. Okay, top of the handout, which item is not on that list, basically? Okay, I'm going to close the question in about 5 seconds. And again, it's the only thing that that's not on that list at the top of page 1. The top of page 1 has a bunch of current liabilities listed. Okay. Sales tax payables, absolutely a current liability. Accounts payable, current liability. Unearned revenue, that's always the Adele's concert that she hasn't performed yet. Those are unearned revenues, current liability. Bonds payable are a long-term liability, and we haven't talked about those yet because we've only been dealing with the current liabilities. We're going to segue into current long-term liabilities in a few minutes. Okay. So then one last one before we start on our long-term liabilities. And this one, before I put the question up, I want to talk through it. So failure to record an accrued liability causes a company to what? No, that's right. I wanted to. Okay, so failure to record an accrued liability causes a company to what? Now, to answer this question, let's ignore all the answers completely, okay? And instead, when we accrue a liability, so what happens when we accrue a liability? We accrued interest on some of those notes on your handout, and when we did that, what we did is we would debit the expense and credit the liability. So when we did it for Detroit Public Schools, we debited interest expense and credited interest payable. Whenever we accrue a liability, we're going to debit an expense and we're going to credit a liability, accrued something payable, okay? And when we do that, we are increasing expense and we are increasing a liability. That's what happens when we accrue a liability. So the question here is, what if we miss that? What if we don't make that entry there? So if we don't make that entry there, so if we do not make the entry to expense, then our expense will be too low and our income will be too high, right? So you can dot off to the side, income too low, expense too low, income too high, okay? And if we don't make that credit to liabilities, liabilities are going to be understated. So debiting the expense, not debiting the expense means our expenses will be too low, income will be, I have not started it on purpose. I want to make sure we understand. I'm going to open it up, but I have not done it intentionally. Okay, so what you're going to be doing, so you should have this kind of like mapped out here. If we don't make the entry, our expense is too low, which means income is too high. And if we don't make the entry, our liabilities are too low as well. Okay, so now I'm going to start it because I wanted to get through that before you answered incorrectly. Okay, so again, this entry is talking about what happens if you don't make the bottom portion. Okay, I'm going to be closing this in about 10 seconds. So what happens if you don't make that accrual entry at the bottom? So we're saying you don't make the accrual, you don't accrue a liability, so you don't make that entry, you should have made it. What's that impact? Five seconds. Okay. That understates liabilities because we don't make the entry. We've understated the liability. Because the entry would increase liabilities, so if we don't make it, we're too low. Okay, so now we're moving on to long-term liabilities during the bonds payable. So we're going to talk about bonds. Now, this slide is in your handout. Okay, this is at the top of page 3. Okay, so top of page 3, a bond is always sold at the market price. It's sold for the bond's present value. Some of this is going to sound familiar because when we talked about bonds as an investment, we were talking about it from being able to buy a bond on the market. Now in this chapter, we're talking about being the company that issues the bond. So again, the slide is at the top of your handout on page 3. So there's 2 interest rates that set the bond price. The first one is the stated interest rate or the coupon rate. Okay, so the stated interest rate or the coupon rate is what the bond pays. That's how the cash interest is calculated. Then the market rate is the effective interest rate. That's what's demanded by the investors for loaning money. Okay, so the stated rate and the market rate are seldom the same. And again, we went through this when we did bonds as an investment. Feels like several weeks ago now. But when we did bonds as an investment where we could buy one and have an asset, now we're talking about from the standpoint of the company issuing the bonds. Okay, so a couple more terminology to know. Par value or face value is the amount that has to be paid back at maturity. So par or face value, you need to know those terms. That's what we're paying back at maturity. When we have a $1,000 bond, that's its par value or its face value. Okay, so par or face value is what you have to pay back at maturity. It's typically when we talk about a $1,000 bond or a $10,000 bond, that's its par value or its face value. Those terms are kind of interchangeable. Okay, now when we talk about bond prices are quoted at a percentage of the face value. Okay, so we're given the face value, we're given the par value, $1,000, and so assume we have a $1,000 face value bond or $1,000 par value bond. Let's say the quoted price is $100. So that bond is going to be sold at 100% of $1,000. So we will have $1,000. That's 100% of 1,000. And that is called selling at par. Again, if this sounds so much familiar, it's because we did it from the other side. This is the mirror image of what we did before. Next up, let's say we have a bond price that's 101.5. 101.5. So what that's saying is the bond is selling at 101.5% of $1,000. So we would take the 101.15%. That translates, just move the decimal over 2 places. So that's $1,000 times 1.015 is going to give us 1,015. We have a question coming up where you have to calculate the price of a bond. So you're taking the face value times that price, and you have to move the decimal point over to, it's a percentage. So this is 101.5%. So that said, that bond, because it's above face value, is said to be sold at a premium. Okay, next up, next scenario. We could have a bond sold below 100, and this one, 88.375, we're going to take the 88.375%, or 0.88375 times 1,000, gives us $883.75 as the price of that bond. And that's said to be a discount because it's less than the face value. Okay, so what I'm going to do now is we're going to do a question. I'm going to switch to the question momentarily, and then I'm going to come back to the slide. So if you don't have it written down, that's okay. The question, I'm coming back to that. A bond with a face value of $1,000 and a quoted price of $102 has a selling price of $1,020. Okay, so the question's out there. Question is still open. I'm clicking back to here in case you need to refer to it to do this calculation. You'll have to do you may have to do a calculation depending on how you are with doing math in your head. So when we get to this one, that 102, I don't have the calculation up here, but the 102, you take 1.02 times 1,000, and you do get the 1,020. Okay, 5 seconds left on that question. Okay, so bond price is taking whatever price you're given times the face value, and that's how you calculate the bond price. Okay, so now for the next for the rest of today and for a large chunk of Wednesday, we're going to be talking about the Anheuser-Busch bond issuance, like we talked about it before from the investment standpoint, but now we're doing it from Anheuser-Busch standpoint. So their official name is AB InBev. But what they did is just to refresh you on the facts, is they did a bond issue of $46 billion because they wanted to add SAB Miller brands to their portfolio. So they're buying Miller Lite, they're buying Coors Light, a multitude of them, but they issued these bonds in January. So our facts, and these are given on your handout on the beginning, top of page 3. So you've got these facts, but Anheuser-Busch issued $46 billion of bonds on January 26, 2016. Second largest corporate bond issue in history because they want to acquire SAB Miller. And then those bonds were issued in increments of $1,000. Interestingly enough, there were only 30 purchasers. This was sold to big institutional investors. And they had a variety of bond maturity dates. The soonest they matured, where they had 3-year bonds, they ranged out to 30. So we just have 3 of the maturities here. I think there were 8 or 9 maturities in total. So we're going to be using those as we talk about the issuance of these bonds from Anheuser-Busch's standpoint. Like, this is a huge liability for them. So not only do they have the liability for the principal for what they borrowed, because it's borrowing when they issue a bond, but they also have interest that goes with that. Then they have principal or discount, which we're going to talk about. So a couple things we need to know, you absolutely need to know, or this is all going to become very confusing. So there's some rules to keep in mind. The coupon rate is the interest rate the bond pays in cash. So coupon rate is cash interest, is basically where that goes. Coupon rate is cash interest. Okay, so that's calculating the interest that the bond pays. Okay, so the coupon rate is the interest rate the bond pays in cash. So when we talk about how much interest does this bond pay, that's the coupon rate, or the stated rate. Sometimes you see it called that. Okay, then the next one then, the market rate. In this, I'm making it very simplified. It's a little more sophisticated by that. The market rate is the interest rate paid by other bonds, like the other kids pay this. So it's what is paid. The market rate is what the market's paying. What others, the average of all the other bonds, are paying. Okay, so we have a coupon rate and we have a market rate. What we're going to do is we're going to start Wednesday with a question that refers to which one is it, what's the coupon rate mean or market rate. So we're going to start the question with that. But what we're going to do right now, well, actually, we're going to end class now, but before I do, you don't have to answer this one again. The feedback question I pushed out to you. So we've come to the end of the material for class today. This is where we ended up my earlier class. So we've come to the end. We're going to start Wednesday. We're going to start with bonds. We are going to do a deep dive into bonds. So if you have any feedback today, any questions about something that wasn't clear, feel free to answer. You do not need to answer. It's up to you. Other than that, have a nice rest of the day, and I will see you on Wednesday.